Hi, Jim Gore from Thor Wealth Management. We talked about the U.S. stock market being expensive, but there's one thing that could derail that, and that is a drop in profit margins with corporations. If you look at this is looking at the profit margins for the S&P 500, and this goes back to 1980. You can see it has steadily increased. The biggest increase was back in the 90s, and that's when the stock market did very well. Now, it makes sense. Profit margins went up because of productivity. Those of us in an older generation remember the floppy disk were our computers. We went from a 286 machine to a 386 to a 486 to a Pentium. So we had huge strides in productivity because of technology, and the stock market went up accordingly, which it should have as productivity increased. Right now, we are at historic highs for profit margins in the S&P 500, and there's two things that can cause those profit margins to fall that we're concerned about at time when stock prices are near all-time highs. What's the first thing that could cause profit margins to go down is inflation. And what we mean by that is companies are going to have to pay more to replenish their inventories. If you look at this chart here, this is looking at inventory to sales ratios. You could see a huge jump up when COVID hit. As we shut down, companies were still getting inventory in while no one was buying anything, but that has dropped off precipitously here as we've opened up and companies' inventories have been drained. So now they have to go ahead and get those inventories replaced at a higher shipping cost and higher material cost. And what we're hearing from companies is that they can pass on some of those costs, but not all of those costs. So if they're not able to pass on all the costs, they're going to have a problem with their profit margins because profit margins will be squeezed. The second thing that we see for corporate profits that could really squeeze them, and we're hearing this from some of our fixed income managers, is the amount of debt that they've added onto their books in the last several years. If you look at this chart here and you look at the red line, this is going back to 1959, the percentage of GDP business debt to that. You can see back in 1984, it was about 15%. It's double that right now, 31%, and you can see a huge increase from 2009 levels. So companies back in 2008, 2009 did a good job paying off their debt, but they've just been adding to their debt right now at a time, if you look at the blue line, as interest rates have fallen. Well, it makes sense. We've had a couple of our clients in the corporate world tell us that, hey, you borrow as much money as you can when interest rates are low. And that's what they're doing right now. And because of that, they have increased debt levels at a time when interest rates are low and people are willing to give them money at very low interest rates. And that kind of shows up here with the triple B, which is the highest quality junk bonds out there. This is looking at, the top part of this is looking at the triple B, which is more of the orange line, versus the 10-year treasury. And you can see there's times that they're way much wider than where they are right now. As a matter of fact, in the bottom, the spread between those is only 0.98. Historically, it's been 1.7. And notice that the times that it really blows out is times of stress, back in, when COVID hit, and really in 2008 and 2009. So this could be a major problem for these corporations. They have huge amounts of debt. They have to refinance that debt. If we have any stress, those rates go up significantly, and it's going to really have a negative impact on their profit margins. So it's something that you have to watch very closely, because if the profit margins get squeezed because of inflation, because of higher interest rates, that's going to cause a problem with the market, especially when it's at all-time highs. Hope everyone has a great couple of weeks. And as always, feel free to reach out to us with any questions or concerns. Take care.